Welcome to the Capital News, everybody. I am your host, Alex Karitis. I hope everyone's doing well. Thanks for joining me today. This is February 12th, 2019. And to get into some economic news, let's start with what took place on the U.S. stock markets today. So if we look at the S&P 500, we gained 35 points. We're up 1.3%. Dow Jones Industrial Average was up 373 points, or 1.5 percentage points. NASDAQ was up 107 points, or 1.5% as well. And the Russell 2000, the small cap index, was up 19 points, or 1.25%. Now, yesterday's action, we saw a lot of whipsawing back and forth, with the averages, some of them ticking up a little bit, and some of them closed down for the day. But today, not so much. This was complete takeoff. Lock and loaded. Markets just went straight up and kept going up, 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 and away. What happened? What was the news? We'll get into that momentarily. Oil was also up 1% and closed at $53.62. Gold and silver were up slightly, but nothing to write home about. And lastly, we have the 10-year Treasury, with the yield also increasing and closing at 2.68% for the day. So this is quite the 180 from yesterday, where we were talking about the dollar strengthening, U.S. Treasuries strengthening, and then today we have more of that flight to safety. That bet was gone. That's over with, at least for today. We will see what happens tomorrow. This is back and forth. That's why I don't predict day-to-day movements on this show. It is a fool's errand. And we are in a market that people who have a lot more experience than I do saying the same thing as me, that we've never seen markets behave in such a manner. I mean, it is day-to-day, it is headline-driven, and that's not to say that there aren't other times where the market's headline-driven. The market loves rumors. It's very much buy the rumor, sell the fact type of market, based off of lower volume, which again does not show a whole bunch of conviction behind this recent rally from virtually Christmas to today. We are in overbought territory, so one would expect some type of pullback. I'm sure many of you also follow either other channels on YouTube, or you watch CNBC or Bloomberg or Fox Business or some other business channel, and you see a lot of market participants and technicians come on and say, from a technical standpoint, some are in the camp that we will do a retest of the December lows. Some think that we will go below. We will hit new lows, and some think it won't be a true retest, but there will be a pullback because we're in overbought territory. Now, you don't have to be a technician to come up with those scenarios, right? I mean, there's only a few scenarios you can have. You can have those three scenarios, or you can have a continued sideways movement, or it can break up to the upside. It seems to be anybody's guess as to what happens. Of course, my opinion overall, and again, not on a day-to-day basis, but the overall trend over the next year or two is going to be down. And I think seriously down. Because there's too much debt in the system. If people are going to be in agreement, and rightly so, that 08-09 was caused by too much debt in the system, well, we have even more now. We have even more now, and we know that the global economy is in the midst of a slowdown. Those two facts are not in dispute by anyone. We are in a slowing global economy, and we have too much debt. Not only in the U.S., everywhere. We have too much debt everywhere. Europe is awash in debt. Japan continues to swim in it. The Chinese are swimming in it. This is global. And again, there is nowhere to run to this time. This is sort of the everything bubble, which you may hear on other channels or in the news. So what was it today? What was the catalyst? What happened? Why was the market on such a tear? Because 1% is a big move. We have 1.25% to 1.5% to the upside today on these major indices. That's a big move. That's volatility. I know those who may watch the markets and follow the VIX, which is sort of the fear gauge, if you will. And of course, that goes up if the markets go down. Now, in my opinion, that's flawed because volatility is volatility. If it goes up 2%, that's a volatile day. If it goes down 2%, that's a volatile day too. But that's not how the VIX operates. But the VIX, for those of you who trade that and might get involved with some options trading on that and trying to time it, if you tried to time it thinking that there was going to be some sort of pullback over the last month, you probably lost a lot of money. Because the VIX has just been going down and down and down because the market keeps going up, 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 and up. But tomorrow's another day. So what was the catalyst? What happened? Well, you guessed it. If you watch this and listen to this podcast, it was some more breadcrumbs on the U.S.-China trade talks. I mean, this is a broken record. It's every day, and it's going to continue to be a broken record because this is the only thing that exists in the market that gives the market hope. And hope, ladies and gentlemen, is not an economic strategy. It's not something we are supposed to be rallying around. We are supposed to be rallying around solid, fundamental economic principles that build and sustain economic growth. Savings, investment, increases to productivity, job training, a whole host of things that make sense, that can be done. But of course, we would rather just tell everybody to go buy stuff that you can't afford, that you don't need, that you'll never use. And then we'll say we have a strong consumer, which I'm going to get to later, which we don't. We're going to say we have strong corporations. Some are, many aren't. We have corporate debt that has exploded since 08-09. We have a propped up stock market based off of all of this debt, based off of financial engineering, using this money, this free, funny money from the Federal Reserve, as a means not to invest in a whole bunch of means of productivity, but rather let's financial engineer our books. Let's do dividends, let's do share buybacks, let's increase our share price so the executives in these companies can make even more money. You can't blame them. Somebody's giving them cheap, easy money. I can buy back my shares. I can retire these shares. I can make my share price look good. My compensation is predicated on share price performance. This is a no-brainer. We can get paid millions of dollars. We can be taken care of for the rest of our lives. We can go on vacation where, when we want. This is fantastic. Now, has it been fantastic for you? No. Has it been fantastic for your neighbors, your family? No. Because the vast majority of Americans are living paycheck to paycheck. So I'm just going out on a limb and taking those who are listening to this podcast as being part of that 78% of Americans who live paycheck to paycheck, which would mean to me that you probably don't own a whole bunch of financial assets, stocks, real estate, bonds, that have just been taking off to the moon over the past 10 years. And any time there's a problem, the hissy fit is thrown by the crack addicts in the stock market and the Fed chairman, whoever they may have been, Uncle Ben Bernanke, Aunt Janet Yellen, or now we got Jay Powell. They come and they say, no, 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 we're going to take care of you. We're going to take care of you. We told you we were going to take it away. We did. We thought you'd be okay. But you let us know if you're going to be okay or not. And of course, the market always comes back and says, we're not okay. Come on, I need that fix, man. I need it. And the Fed acquiesce, and they give it without question. Have completely lost credibility. The Fed has no credibility in my mind. None whatsoever. It's just a question of time until everybody else who's playing this game around the world, and they all just say, well, you know what? We don't find any credibility in you either. We don't find any credibility in the Bank of England. We don't find any credibility in the Reserve Bank of Australia, the People's Bank of China, the Bank of Japan. Pick a bank, we have no credibility in it. It's just a matter of time until people start waking up and governments start realizing that, hey, I can't keep buying your debt because I have too much of my own that I got to start taking care of. So good luck with that, pal. That's what's coming. That's what's going to happen. Why? Because it's the easy way out. It's to kick the can down the road. Well, we're running out of road. And our legs are getting tired. All this kicking. Unbelievable. But back to that catalyst. Again, U.S.-China trade talks. Well, what was said this time? Of course, it was good news, right? That's why we rallied. That's why we rallied. So the good news this time was we are going to continue our talks, which we already knew. And Kellyanne Conway, an advisor to the president, made a comment stating that President Trump wants to meet Chinese President Xi, soon. Well, that shouldn't be a surprise either. So the question is, well, what does soon mean? I don't know. Uh-oh. What does soon mean? Like tomorrow? The next day? I mean, March 1st is the deadline, people. That's a couple weeks away. That's soon. You finish a deal that people meet, they sign something in, I mean, hello, that's politics. Reagan sits down with Gorbachev. You talk, you meet, you sign something. What am I missing? Because we had a conversation the other day about being miles and miles apart. I think we still are miles and miles apart. And in fact, now, the other thing that President Trump said, he may extend the deadline. If we can start getting closer to an actual deal of some of the hard stuff, not just the easy gimmies that might exist on all of these bullet points that they're going back and forth on, but some of the meat and potatoes of the deal. And if we can get closer to the meat and potatoes of the deal, then just maybe, we'll extend the deadline. This goes to the previous podcast in attempts to avert a government shutdown and border wall funding. Is this another art of the deal tactic? Where you start to bend over and just let everybody take advantage of you? And then boom, you turn around and say, I gotcha. I don't know. But I don't think so. There is a lot of leverage on both sides of this trade deal that the Chinese can use against us and that we can use against the Chinese. Basically, they're both holding a hand grenade and they each got their hand on a pin. I mean, they could decide to keep the pin in and work something out, or they could decide to pull the pin and everybody's messed up. That's where we're at here. The Chinese hold a ton of our U.S. treasuries. Do they want paid? I mean, is that what we're talking about here? Is the Trump administration going to hold that over their head? We won't pay you unless you come to the table and do some things that we want you to do? Because the Chinese could just say, well, hey, we know your economy is not as strong as you pretend that it is. Because if it was as strong as you say that it is, you wouldn't be accumulating near $1 trillion deficits. You just don't do that. If you have a strong economy, you don't accumulate $1 trillion deficits. They know this. So what does that mean? That means that Uncle Sam is going to have to continue to issue debt. Well, who's going to buy it up? Well, the Chinese can say, well, we're not going to buy up the debt. What does that mean? That means a couple things. You're going to have to find somebody else in the marketplace to fill that void, that extra demand for those U.S. treasuries, or you're going to pay a higher yield, which just means your interest payments are going to eat up that much more of your annual budget. Not a good situation. Not a good situation. And that's probably going to happen regardless of what happens with this trade deal. The other situation that could transpire is another round of, yes, you guessed it, wait for it, wait. I heard it. Quantitative easing number 4. It almost sounds like a whiskey. Quantitative easing number 4. Have a sip every time you come home. Off the chart crazy. Because you're going to have the Federal Reserve monetize the debt again, which could decimate the dollar. But again, if everybody else is doing it the world over, then it just becomes a question of relativity. So we'll see what happens with the U.S.-China trade talks. Another day, another dollar, another story, another headline. Tomorrow we might have a deal. Tomorrow we might be even further apart. Buy the rumor, sell the fact. But we know that these rumors have contributed to 1,000+ points in this market rally for the past month and a half now. So when a deal is struck, how much more are they going to rally at the end of the day? So that's a serious question. Now, the next thing, because I said I was going to touch on some consumer debt. Now, I have an article on the website, thecapitalnews.com, and of course that's capital with a K, thecapitalnews.com. And you can also find this on CNBC. And allow me to read some of this to you. So, a record number of Americans are 90 days behind on their car payments. More than 7 million Americans are at least 90 days behind on their auto loans, according to the New York Federal Reserve. That's higher than the peak in 2010, as the country was still reeling from the devastating financial crisis. The number of distressed borrowers suggests that not all Americans have benefited from the strong labor market and warrants continued monitoring and analysis of this sector, Fed economists say. Well, no duh. No duh. What have I been saying repeatedly? The consumer is not strong. The consumer is not in good shape at all. It's not just a question of unemployment rate. It's a question of, one, how is that unemployment rate calculated? And two, what type of jobs are we talking about? How many people are counted as employed but are working part-time? They want to be full-time, but they're part-time. Maybe they got a couple part-time jobs. What are they getting paid? It's not quantity, it's quality. That's what you have to look at. It's nice and easy for a politician to get up there and say, I have the lowest unemployment rate in 50 years. Pat me on the back. If I had the choice, if I was president, I'd rather have a higher unemployment rate, but the quality of jobs being of higher caliber, because that means the American people are going to feel it. Okay, this is just a charade. The 4% is just a charade. It's just a game. Because people truly know whether or not they are better off or not. Okay? And I don't lay this at the feet of President Trump, by the way. He inherited a mess. He walked into $20 trillion in debt. He walked into endless wars. He walked into a mess. Okay? So to expect this man to turn it around and work miracles within a couple years is just beyond the pale. Okay? I think the man's doing a good job on a lot of fronts. Of course, you know I criticize him on many others. But I just want to lay that out there, especially for people who may be tuning in for the first time. So allow me to continue with this article. As auto loan debt has soared, so has the number of people who can't pay, with the level of serious delinquencies breaking past the heights reached just after the financial crisis. More than 7 million Americans are 90 days or more behind on their vehicle loans as of the end of 2018, according to data released Tuesday by the New York Federal Reserve. That's more than 1 million. That's more than 1 million higher than the peak in 2010 as the country was recovering from its worst downturn since the Great Depression. Ladies and gentlemen, the consumer is not strong. The substantial and growing number of distressed borrowers suggests that not all Americans have benefited from the strong labor market and warrants continued monitoring. The surge in delinquencies came along with a $584 billion jump in total auto loan debt, the highest increase since the New York Fed began tracking 19 years ago. Now the article continues. On the bright side, the overall level of overall credit quality actually improved, with those at the lower end of the spectrum declining to 22% of the total share, while 30% of the $1.27 trillion with a T, in total auto debt is now held by those on the higher end of the scale. Those numbers would suggest that the overall auto loan stock is the highest quality that we have observed since our data began in 2000. However, with growth in auto loan participation, there are now more subprime auto loan borrowers than ever, and thus a larger group of borrowers at high risk of delinquency, the report noted. Now, don't forget, and I'm going to do some more research on this, but I believe it was not in the too distant past that the way credit scores are calculated has changed. And it has changed with an upward bias. Meaning, if you were a subprime borrower and you were close to near prime, you got bumped up. And if you were near prime, but you were close to a prime credit score, you got bumped up. Now, why did they do that? Because the banks are swimming in liquidity with all this funny money, and they got to do something with it. But because of the 08-09 crisis, you have different lending standards. And because subprime was a hot-button word, you can't lend to the subprime people. Well, guess what? The consumer's not strong. It sort of limits your pool of people who you can make loans to. So what do? Scratch your head, think about it, get all the smartest people in the room. I got it. Let's change the definition of how we define subprime. Let's change the credit scores. Figured it out. And that's what they're doing. That's what's taking place here. We don't have a strong consumer. Unbelievable. Let me see a couple other things here on this, because of course they get into student loans too, which is obviously very important. Because a lot of these people who are delinquent, 90 days plus past, are making a car payment, are undoubtedly people who also have student loans. What are they doing? Are they renting? Can they afford rent? Do they have a house? Do they have a mortgage? Can they afford the mortgage? What are they determining that they're going to pay? I mean, typically if you have a car, you probably need it to get to and from work. So if people are making a decision to give up making a payment on a car, that's not good, ladies and gentlemen. Now, this is very much akin to what happened in 08-09 in regards to the subprime borrowers in the housing market. You put very little money down, if any. You end up having negative equity, meaning the mortgage is more expensive than the house. and you walk away. You say, screw it. It's the bank's problem now. It's not mine. I'm done. Yeah, it's a house. I'm sure you have an emotional attachment to it, no doubt. But where are you going to come up with $300,000 on a house that's worth $200,000? Doesn't make sense. It makes more sense to walk away. Is that what we're starting to see in this report from the Federal Reserve regarding auto loan debts? Is it? We're going to find out. From the data that I look at, from all of the debt that I look at, I would say yes. This is not surprising to me. This is just finally in a report that's acknowledged. Now, the markets won't focus on this. They're going to continue to focus on, well, we have a trade deal. No, we don't. Tomorrow, oh, we have a trade deal. No, we don't. They're not paying attention to any of the real news underlying this market, this economy, this global economy. They're focusing on hope for a trade deal that's probably 80-90% priced in already. I appreciate the hope. I really do. I'm an optimistic person. But I tell you time and time again, I'm not going to sit here and lie to you. What's also optimistic is being realistic and getting a vibrant and healthy economy going again. And you're going to have to do that through deleveraging. And there is a ton of debt in the system, so it's going to be a huge deleveraging process. It's going to take years. Whether or not the stock market sells off 30%, 40%, 50%, maybe even more. I wouldn't be surprised if over the next couple of years it is even more than 50%. But this is what has to happen. You get sick, you got to clean your system out of the virus. It's just how it works. You keep eating cheeseburgers every day, you suffer a heart attack, you can't be surprised. Change your diet, exercise. What do you think we're doing as a nation? We're eating too many cheeseburgers, we're getting clogged up. Now you can continue to say this is a strong economy. That's propaganda. That's propaganda because we're in a trade war. You can't let the enemy see you're weak. And our quote-unquote enemy in this case is China, and they're weak. I mean, we have, 3% GDP growth? Well, China's double that, according to their statistics. I have a hard time believing U.S. statistics. You know damn well I don't believe the Chinese. So that's all this is. This is propaganda. The truth is the first casualty in war. This will continue until a deal is struck. What type of deal it will be is anybody's guess. But I will do my best to keep everybody informed and to provide my insights on all of this. And I thank you all for taking the time to join the show today. For those of you who may be watching on YouTube, please be aware that I do have a website, thecapitalnews.com. Thecapitalnews.com, and of course that's capital with a K, so make sure you check that out. I post articles on there from time to time, and you can also find the podcast there. And of course, if you're listening to this podcast from my website, be sure to check out my YouTube channel, as I will be posting other videos showing some of the charts, graphs, and data that I look at to prepare for these podcasts. And instead of that just being a voiceover, that'll actually be a video. So you actually get to see what's going on, and this stuff is just startling. Just from looking at it, you know it's not right. But take care, everybody. Thanks for joining me. This is the Capital News. I am Alex Koritis. Godspeed.